2025 felt like the economy and markets were playing a giant game of financial chicken. On one side, bears were yelling about a recession on the horizon, and on the other side, bulls were buying AI stocks like it's the last Pokemon pack on the shelf.
But over the last year, unemployment remained relatively low. Consumers kept swiping credit cards like it wasn't real money.
And anyone who shorted Nvidia aged a decade. It was a weird year, a confusing year. And now, we're stepping into 2026. Rate cuts? Maybe. AI bubble pops? Perhaps. Soft landing? Hard landing? Or no landing, like my dating life.
This is the year we could see markets blow the top off. Or it could be the year where you look back and think,
I should have just bought treasuries and shut the fam up. And after getting flooded with messages. Asking what I think about the markets going into 2026, I realized something. Instead of answering hundreds of messages one by one, I could just make a video. And I know it's already 2026 and I'm a little late, but hey, at least we're here. And to be transparent, I see a few possible scenarios playing out. I see the bear case, the bull case, and the uncomfortable gray area in between.
so here's my 2026 market outlook and what I could see possibly happening. Let's start with the bear case.
It's only right to start with the elephant in the room. Because whether you think AI is going to reshape the global economy, because the numbers don't lie. Nvidia trades at around 47 times earnings. Palantir sits around 400 times earnings. At this point, there's no investing on fundamentals. You're just pre-ordering hope.
And the problem is, AI stocks are dragging the entire market up with them.
Because when Nvidia goes up, it pulls semiconductors up, which pulls the tech sector up, which pulls the S&P up.
And suddenly you look around and realize the S&P is trading at nearly 31 times earnings, which is nearly double the long-term average of around 16.
And if these trading multiples normalize back to historical averages, it's not just AI stocks that take a hit. It's the whole market.
And we haven't even talked about the circular spending problem, or that 95% of companies are realizing zero return in generative AI.
So for now, we'll move along to the next point in the bear case. Because there's another issue that goes hand in hand
With the stretched valuations in the market. And that issue is, the market is top-heavy. Because the S&P 500 isn't being lifted evenly by the 500 different companies. It's being dragged higher by a small handful of tech stocks.
Some people call them big tech. Some call them the Magnificent Seven. Wait, not that one. Anyways, I just call them 35% of the entire S&P 500. That's right, over a third of the entire index's total market cap.
And an even larger share of its returns come from just 7 companies. And if you swap Tesla with Broadcom in the Mag 7, that contribution increases to over 55%. This means the index that's supposed to represent broad diversification across industries is quietly turning into a very concentrated bet.
And that's something to worry about, because it's starting to look like a group project where 2 people do all the work and everyone else still gets the credit.
And the explosion in passive investing is quietly pouring fuel on the fire. Because most index funds are market cap weighted, meaning a stock's influence in an index is directly proportional to its market cap. When new capital flows into these funds, it disproportionately gets allocated to those same tech names.
It's a feedback loop that's beautiful, right up until it isn't.
Because when indices become this top-heavy, small moves can turn into big problems.
A 10% pullback in Nvidia's stock doesn't stay isolated in Nvidia. It bleeds into the NASDAQ, the S&P 500, and creates broader market pressure.
And suddenly what you thought was a diversified portfolio is reacting to the mood swings of a handful of stocks. All it takes is the Mag 7 stocks to stumble for the whole market to slip. Which brings us to the final point in the bear case. 3. We're due. I'm not saying a crash is imminent, and I'm not predicting financial Armageddon. But statistically speaking, We're overdue for a down year. Nerds would call this a reversion to the mean.
Because markets, especially US equities, go through cycles. Since 1954, the S&P has averaged a pullback of at least 10% every 3 years. And after several years of outsized returns, history tends to tell us we need to pump the brakes. Because corrections aren't anomalies. They're actually normal and healthy.
However, as Michael Burry showed us recently, going short the market because of a gut feeling is probably not the best strategy. Because as famous economist John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent.
And that's the uncomfortable truth about the bear case. You can be right on valuations, right on unhealthy concentrations, and right on overextended rallies.
Because being right too early is indistinguishable from being wrong. Which brings us to our bull case. Because what if markets continue to rip? What if they don't care about historical averages? And what if markets continue to remain irrational?
So let's start with the fundamental tailwind that bulls are clinging to. 1. Interest rate cuts.
Because whether you trust the Fed or you think Jerome Powell runs monetary policy decisions through a magic 8 ball, one thing is clear. Interest rates are coming down.
And lower rates mean cheaper capital. Cheaper capital means higher valuations. And higher valuations mean investors are more comfortable paying premiums for future earnings.
And that's why rate cuts don't just matter to borrowers, but also to valuations and trading multiples. Because liquidity loosens, financial conditions ease, and risk-on assets come alive.
And that's how you can see markets grind higher, even when underlying economic data may feel mixed, confusing, or slightly uncomfortable.
But just because the broader macro picture may feel uncomfortable, it doesn't mean that you also have to be. Which brings us to the sponsor of today's video, FlexiSpot.
Because 2026 will probably be a year in which you're spending more time at your desk reading 10Ks.
Looking at charts and tracking news flow. Which is why investing in a quality setup matters.
Because while traditional desks lock you into one position all day, standing desks, on the other hand, encourage movement and support flexible work styles.
And the FlexiSpot E7 Pro delivers all that and more. With a height range from 25 inches, and it's also built with stability as a priority. The E7 Pro uses a dual-motor, 3-stage, semi-C leg structure,
which allows it to support a static load capacity of up to 440 pounds, meaning stability is never really a concern.
FlexiSpot also backs the E7 Pro desk with a 15-year warranty and 30-day risk-free return policy.
If you're interested in the E7 Pro, I'll leave a link below and you can use my code to get $30 off. And now, back to markets.
Because the monetary policy backdrop I previously covered is only half the story. The other half is fiscal policy. Which brings us to the next point in our bull case. 2. Deficit spending. Because while the Federal Reserve argues over quarter-point cuts, the US government is doing something far more impactful: spending.
And I've made videos on this channel about how the deficit is becoming a serious problem and the potential long-term damage it will cause.
But the reality is, in the short term, it brings some benefits as well. Because government spending puts money directly into the system. It supports consumer demand, props up corporate revenues, and keeps economic activity high. Hooray!
And unlike monetary policy, fiscal policy is slow to change. Because programs don't get shut down overnight, budgets don't just get suddenly slashed.
And politicians don't win elections by campaigning on frugality. So even if growth cools, the fiscal backdrop remains.
Because when fundamental tailwind with real structural risks,
the most likely outcome is the one nobody's positioned for.
On one side, you have the optimists, the people talking about rate cuts, continued government spending, and how AI is the best thing since sliced bread.
And on the other side, you have the pessimists, the people talking about an AI bubble, a top-heavy market, stretched valuations, and how we're overdue for a correction. These are the people expecting 2026 to finally be the year things break. But here's the scenario I have yet to see anyone talk about. Not a melt-up, not a crash,
but a market somewhere in the middle. The kind of market where headlines flip every 2 weeks, rallies stall just as confidence rises, and dips feel scary without ever bringing real opportunities.
I'm talking about a long, choppy, sideways price action year. And it's these markets that are often the hardest to survive.
It's where impatience destroys portfolios. It's this gray area in between a bull and bear market that is so dangerous.
Every decision feels wrong, and capital just rotate between asset classes. And when markets feel like this, it's a good reminder.
And if anyone tells you they do, well, they're either lying, trying to sell you something, or both.